In today's video, you'll learn about some tricks of the trade. These are basic rules of thumb that experienced short-term traders use to attack the markets. All of these shortcuts will help you manage positions more effectively or help you understand when risk-reward is more in your favor to execute a trade. As you develop more rules of thumb, it will allow you to pay less attention to the unimportant things. And as you're using less mental capital to pay attention to the unimportant things, you're going to have more energy and focus to execute your top trade ideas. My name is Steven Spencer. I've been a short-term trader for over 20 years. I'm a partner at a proprietary trading firm in New York City where we teach new traders how to trade stocks, futures, and options. We have taken 2 hours of our training to make a free workshop available to you. You can receive access to this workshop by clicking on the link that should be appearing now up on the top of the video. When you click on that link, it's going to open a new page. In no way will it interfere with this video. So you're not going to lose this video. Click on the link, opens the registration page, put in your info, sign up for the time you want to watch the 2-hour free webinar. I can tell you for sure you'll learn more in that 2-hour free webinar than you will of watching hundreds of hours of online videos. The reason I know this is I came up with most of the material. It's fairly unique, it's dense, it's great stuff. Check it out. Let's take a look at a handful of rules of thumb that I use on a daily basis to help me manage my trades each day. So these are all based on my observing tens of thousands of trades over the years. Came up with these. You're not going to learn about them in trading books. You're not going to learn about them anywhere else. Maybe some people learn them from watching the video now and then they'll create a video using them. But I think until today, for the most part, these are pretty unique. You'll recognize some of them. There's going to be some overlap, I think, in one or two of them where they're kind of based on or offshoots of traditional things that you'll hear about from experienced traders. But these are not things you're not going to learn about unless the person is an experienced trader talking to you, in which case they probably use them as well. Okay, so the tips for today. There's 5 of them we're going to talk about. The first one is what I call IPO percentage moves. And they are basically what this rule of thumb can be used for targets and potential failure areas. So let's take a look at the first one. So here's a chart of Sonos. This was a hot IPO a couple of months ago. It IPO'd at $15 a share. General rule of thumb for you. If something is a hot IPO and it's showing strength and the first day is very strong, and it's running, a really good rule of thumb is to understand when it gets 50% above its IPO price, that's where a lot of experienced traders, hedge funds, people who are making momentum trades, experienced momentum traders, will look to take profits in sales. And so therefore, what happens when people are looking in the same area to take sales, a stock will lose its upward momentum and quite often turn around. And when other people recognize from a technical perspective it's losing momentum, starting to trade lower, that can be a spot where the stock reverses pretty strongly. So in the case of Sonos, when we're looking at the chart, we know on day one it opened a few dollars above the IPO price of 15. It closed strong above $20 a share. The next morning I knew when it got to between 22 and 23, 50% above the $15 IPO price, that was the area where I'd be looking to sell, to short into, to look for a reversal. And you can see right on the open, it shot above the blue line, 50% above the IPO, kind of started to move sideways a little bit, got back down below. And once it gets back down below, if you're long, you need to look to exit. If you have shares that you've located, you can look to short and look for it to come right back down to the prior day, fill the gap, etc. You can see it filled the gap, got a little bit below that. So that's one of the rule of thumbs I always use. So that was the first one. And we have a few others to go over. And the basic idea, again, with rule of thumb is after you see these setups over and over again, you kind of develop these shorthands, these shortcuts. And these are just things that are not apparent to the novice trader, and it applies to any other performance field. It's whether you're playing basketball or golf or football, You can learn the rules of the game, but until you've played it many times, you don't pick up on these things. And the second one is breakout percentage moves. This is another one, just like the first one, the IPO percentage moves. It's going to allow you to develop targets in failure areas. And again, when you're able to develop target and failure areas, you won't obsess over every price, every tick. You're going to have more energy. You're going to be able to focus throughout the day more easily if you're not paying attention to a lot of extraneous information. So let's look at an example. Okay, so here's a stock that's been really hot recently. This AMRN had really good news. We know that it gapped up to about $12 a share in the pre-market on day one. We know that it pulled back to $10. And then what we were looking for on day two was a breakout above $12. And so on day two, you can see I've circled the area. It broke out above 12, and then it ended up failing. The top blue line I had is 15. I thought it might get up to $15, but it failed at 14.5. And we know that 14.5 is $2.50, about $2.50 above 12, or it is actually $2.50 above 12, and it's about 20%. And so that breakout of 20%, I'm going to keep that in mind when the stock consolidates for a few more days and the next time it has a breakout, understanding that the people, the momentum traders playing this, the first time it broke out, it went 20%. So let's fast forward to a couple of days later after that, and it was consolidating just below $15 a share, you can see on the open, and it broke out above 15 because the first breakout went 20%. I just basically did, okay, $18, that's 20%. And you can see that it actually got to $18 in the middle of the next day, and it failed there. You can see it spiked above it a couple of times. And so what I used there is I used it as a target, but at the same time, when it actually got above it, you can kind of see the wicks on the 30-minute there, and there's a big red bar, and it came down to 17.5. Once I saw that failure there, and it came back up to 18, I said, I'm going to use that as my short. And so then I was short it all the way back down for the next day and a half, right back down to kind of the area it consolidated and broke out from. And so that was quite helpful, understanding the first move from 12 to 14.5 was 20%, that I was going to look for about 20% on the next breakout. Good for a target area, and then good for the reversal and in the short trade. Very helpful. Okay, our next rule of thumb. Oh, so just to remind you, the rule of thumb there is, in stocks, once you identify the size of the breakouts, the next breakout, let's look and see if it's going to be similar. And that's one that actually you've probably heard people use the terminology measured move before, and that is a fairly common term you'll hear experienced traders talk about, technical traders talk about, and it can be used on different time frames, intraday and multi-day time frames. And that's just one specific example of how to look for a measured move. This wasn't, from an intraday perspective, where we normally talk about it as short-term traders, this was a little bit different. So not quite the traditional way that people might talk about measured moves. The next one is ATR After Earnings. So as you know, on our desk, we're trading in play names. This is the thing that we do really well. We have a morning meeting where we talk about these stocks. And a lot of times people will ask, how do you come up with the targets? And pretty much ATR, average true range, which is basically the last 21 days. This is usually how it's calculated. The last 20 to 22 days, the average move from close to close. So if on Monday a stock closed at $20, and then on Tuesday it closed at 21, and that happened to be the average move over the last month, your ATR would be $1. We find that stocks quite often, the day after they report earnings, will move multiple ATRs unless they're stuck in a range, and then we'll look for that one ATR. If it can break out through the one ATR range, we'll then think about in terms of ATRs. Okay, it broke out from its ATR range. We'll go another ATR today, and you'll find just another rule of thumb, not the one we're going to look at here specifically, but lower price stocks will move more ATRs when they have a catalyst. So like a $5 to a $10 stock, which normally has a very small ATR, has a big catalyst, it might move 3, 4, or 5 ATRs. Where a higher price stock, generally 2 ATRs is a pretty big move in a higher price stock. So let's look at an ATR move. The example was Micron. MU reported earnings recently. We know that in the pre-market, it had a very strong move from about 43.85 and went up to 45 in the pre-market. We had that as a level that we were going to look at on the open, and then we highlighted 45.5 because 43.80 to 45.5 is one ATR. It turned out that the area we highlighted in terms of using this as a potential range on the open, that's what it was. It pulled back to 43.80 right on the open. It popped up to 45.5 and failed. And then it came back down to the opening low. It held there again. It popped up to the opening high. It held there again. And it never broke out and trended the rest of the day. It just stayed within one ATR. Understanding that stocks quite often after earnings will be range bound. Most stocks, actually, they won't trend. But understanding what areas it needed to break through in order to trend and where it could potentially fail, that was very helpful to me in terms of fading. And I faded it the first time on the short side at 45.5 and then looked to get long into 44 within the 1 ATR range. So that's example number 3 for our rules of thumb. Fourth rule of thumb, growth stock lowers projections. So, and we have an example for this. So this one is SFIX. Here's the basic rule of thumb. And we just actually talked about kind of the opposite scenario. So in MU, we talked about the idea that stocks after earnings are going to be, for the most part, range bound. When a growth stock, this is a stock that has increasing earnings and revenue guidance quarter after quarter. They're growing very strongly. You can generally see on the chart they're trending up very strongly. Usually in the last 6 months, they're up a high percentage, 30 to 50%, or sometimes they've even doubled. What happens is if they release earnings and then their forward guidance shows any hint of them not continuing to grow, they can get hammered. And so on this chart here, what we see is before the earnings, the stock topped out around $50 a share. It gaps lower. We've highlighted, based on the uptrend before earnings, 3 areas where it supported before it put in a top on the higher time frame. One area was into 36, the second area was into 32, and the third area was into 28. And notice how methodical that is. I'm just noticing it myself, that each of those support areas was $4 apart. So it's just a very technical traded stock, very methodical where the support areas are. So if a stock, in this case, the October quarter revenue guidance of $354 million to $360 is below the $360 consensus. It's a very small guide down, right? The midpoint of the guide down is less than 1% below the guidance. And so you would say to yourself, normally, the stock is a $44 stock. It's gapping down about 20%. They're only guiding down 1%. That's crazy, right? In fact, I even said, probably in the morning meeting, I don't remember exactly what I said, but I may have said, look, they guided down 1%. It's a growth stock. It's already down 20%. It could bounce. But because of this rule of thumb we have, a growth stock guiding down in any way, even if they had not raised guidance, that would usually cause it to gap down, but they actually slightly lowered it, it might just go, people might just pile on and get the hell out, and it might go all the way down to the third support area. And that area over the next few days, if it can form a base there, then we'll look for it to pop back up to support area 2, and maybe ultimately it will move all the way back to support area 1. But I will be 2 things. Because of this rule of thumb, number 1, if it's holding on the open below support area 1, I'll treat it on the short side. And number 2, I'm going to be very careful about looking for a bounce and getting long, unless it's coming into one of these major supports, in particular support 3. Maybe not on day 1 support 3 because it's just an overextended move. But it's a really good rule of thumb to use. Growth stock lowers guidance projections. And I think we have one more rule of thumb. So this is kind of a little bit of a crazy one. In trading, we know that the more a support area is tested, the more likely it is to break. I've found that if something is tested 4 times, on the 5th time, very rarely does it hold, and you can see a tremendous amount of downside. I'm going to give you 2 recent examples on different time frames. One was on a multi-day time frame, and one was on an intraday time frame. And let's take a look at them. Okay, so the first one is AMD. AMD recently had a breakout from $30 and went up to $33, $34. it had some news a few days ago. It came down to $30 on the open from 31. And my thought was, this is going to be a really good short. It's going to crack, etc. And it got down there at 10 o'clock. And you can see we're looking at the 5-minute chart. Somebody was buying hundreds of thousands of shares at $30. And so I covered my short, actually got long. And then it got tested again in the morning. You can see that next 5-minute bar, it got hit again, and it didn't break. And then you can see it had a bounce up to about 30.50. And then over the next couple of hours, it moved sideways, but each little blue line there, notice that the sellers came down a little bit more. And eventually, in the early afternoon, it came down to 30 again. It hit it, that circled area on the right, hit it again, and then it hit it again. That's 4 times. It pops back up. You can see that final blue line. Really wasn't even a bounce the 4th time. Only went up to about 30.10. So it's coming into 30. What happens? Let's look at the next chart. It drops 30. There's a huge spike in volume. This was probably the biggest winning trade on the desk of the day. We were short, I think, well over 100,000 shares at the firm. And what you're expecting to see when the volume spikes and it gets below $30 and takes out $29.90 is at least a move very quickly to $29.50, at which point traders will generally cover 25 to 50% of their risk, and then they'll look for a bigger move down to $28 to $29. The way that you trade this, when it breaks there in volume and you're hitting it below $30, you put in your stop above that final blue line where it made the last lower high, above 30.10, and you're talking about 20 cents of risk max for $1 to $2 of downside. It's a very good risk-reward trade. The rule of thumb is something is tested 4 times, and then the bonus was lower highs here, so you can kind of see the sellers are stepping down. Something had to give. Be aggressive. Be aggressive. And then the general rule is for traders is the more you see a level tested. So after people see a level tested 2 or 3 times, they're probably going to be aggressive on the 4th time. I've seen things hold 4 times and actually bounce. By the 5th time, it's extremely rare that you get a bounce. The other chart on Sonos, which we talked about earlier, Sonos, the 50% rule in IPOs, was it had tested 16.5 on the daily on different days, 4 different times, and on the 5th time it tested it on the daily, it got below, it broke and ended up going down about 20% over the next couple of days. This is a trade that the young traders on the desk actually took. It was a simple trade, easy trade, higher time frame, something had been tested multiple times, hadn't been below there since the day of the IPO, and when it took that out, it trended down quite well. I actually have one more rule of thumb, the bonus one that I've seen young traders do quite often, and just don't make this mistake. It's about stop placements. Never, ever, under any circumstances, if you're long a stock and it gets above a whole number, place your stop above the whole number. The reason why this is an important rule of thumb is institutions, larger traders, always have bids at whole numbers. And so you don't want to get out of a stock, you don't want to hit out of your position unless all of those large bids get hit out. And the reason is you want to see that there are sellers who want to get the hell out of the stock. And you have a lot of supply there and liquidity. And once it's proven to you that those bids are going to get taken out by the sellers, then put in your stop. So it's one of my pet peeves. I see young traders do this all the time. All experienced traders know this. So here's an example, AMD. We'll look at it again. This one actually went down to 27 the next day after it broke down through 30, which we just talked about. And we were looking for a bounce from 27 based on the higher time frame, the daily chart. And what happened was it bounced from a little bit below 27. Once it got above, if you had a trailing stop, it had to be below 27 for some of it, and then the rest was below the low of the day. And when it comes back down to 27.05, don't hit out of any of your position. 26.99, 26.98, even below 26.90, fine. And as it continues to trend higher, I highlight another spot for you above 28. When it gets up to 28.25, 28.30, don't put your stop below 28.10 or 28.05. Put your stop below 28 because people will step up to that level and buy. Real basic, good rule of thumb, use it every day. So to recap for you, develop rules of thumb in your trading. These shortcuts are going to allow you to pay attention to the important prices, to set targets more easily, understand when you really have to focus and pay attention. This is going to help you conserve your mental capital, your energy. So by not focusing on every tick, you're not going to be exhausted by 11 a.m. each morning, and you're going to be able to execute better on your best ideas and capture more opportunities each day. I hope this was helpful.